Hello everyone, and welcome back to Collin Investing, your go-to channel for in-detail analysis on finance and investment. I am Collin, and today we're diving deep into a market landscape that's being reshaped by everything from tariff announcements to AI breakthroughs. We have a lot of ground to cover, all related to finance and investment, from Trump's latest moves to the exciting and sometimes confusing world of AI-driven stocks. Consider this a situation where you will get a complete view of the current investment environment. We started today with a broad overview, and now we're zeroing in on some significant moves by Trump that are sending ripples through the global markets. First off, he's pushed back the tariff deadline for Canada and Mexico to the 2nd of April. You might be thinking, okay, a delay, maybe things are calming down. But that's not the whole story. Simultaneously, new tariff investigations are underway, and this time, copper is in the crosshairs. The countries most exposed here, Chile, with a whopping 38% of U.S. copper imports, followed by Canada at 28% and Mexico at 8%. Imagine that, almost 75% of the copper import of U.S. will probably be affected. This has already created a noticeable divergence in copper price. U.S. prices are shooting up, exceeding $1,200 per ton, while global prices are behaving differently. It's a clear demonstration of how quickly these policies can impact specific markets. And, as if that weren't enough, here is now talk of a potential 25% tariff on a wide range of EU goods, including automobiles. Now, we are not sure yet about the certainty, but this will potentially affect the automobile market significantly. This is a big deal, and it signals a potential escalation of trade tensions with Europe. We are not just talking about a simple negotiation. We are looking potential new rules in global market, however. Here is a counterpoint to consider. Shifting gears to domestic policy, the U.S. House just passed a budget resolution, and this is a crucial step towards a massive $4.5 trillion tax cut plan. This could be a significant stimulus for the U.S. economy, a point we'll explore in more detail as it has direct implications for corporate profits, as we see in the next part. Building on that point about potential economic stimulus from tax cuts, let's dig a little deeper into how these policies might play out in the real world and what other economic crosscurrents are at play. On one hand, yes, tax cuts and deregulation could absolutely boost corporate profits. More money in the hands of businesses often translates to increased investment, expansion, and potentially higher stock prices. And it is a fact. And this is a significant but. We can't ignore the other side of the coin. All this uncertainty surrounding trade policy, those tariffs we just discussed, they have the potential to create inflationary pressures. Think about it. Higher import costs get passed on to consumers, and that could eat into the benefits of any tax cuts. So we have these two powerful forces, tax cuts and potential inflation, potentially pulling the market in opposite directions. It's a tug of war creating volatility. Now, let's shift gears completely to something, well, let's just say it's unconventional. Trump is proposing what he calls a gold card visa program. Essentially, you can buy permanent residency in the U.S. for a cool $5 million. I know. It is a bold move, right? While this might seem unrelated to the broader market trends, it's actually relevant. It is relevant to the next point I am making, and that's where this next point comes in. The U.S. economy is becoming increasingly reliant on the spending of the wealthiest individuals. I am talking about the top 10% of earners. They now account for almost half of all consumer spending in the country. That is a huge number. This concentration of spending power means that the overall health of the economy is, to a large extent, tied to the fortunes of a relatively small group. So what does this all mean for you? Consider a situation where a significant shift of this high-income spending pattern happens. With all the global market shift, including tariff and policies, it is not hard to imagine it, and here's the kicker. Even among this wealthy demographic, consumer confidence is starting to dip. Some of this is directly attributed to the uncertainty caused by, you guessed it, those tariff threats. So while tax cuts might offer a boost, the broader economic picture is complex with several factors, including policy decisions and consumer sentiment, all playing a crucial role. So what does this all mean for specific stocks? Let's talk about a couple of recent calls, starting with TRMF, the long-term Treasury ETF. Remember, we'd been discussing the potential for falling Treasury yields, driven by both the fear of a recession-style rate cut by the Federal Reserve, and also the expectation that the rates would come down. It played out, and those who followed that line of reasoning saw a nice return. We're talking about consistent gains here. This brings us to a critical question. How about the high-flying world of tech? This is where supermicrocomputer or SMCI comes in. Now this one was a bit of a nail-biter, wasn't it? There were concerns about the company's regulatory filings, the potential for delisting, a real cloud of uncertainty hanging over it, but they managed to submit their financial reports just in the nick of time. And remember what we said when it was hovering in that $30 to $40 range? It is a good buy. Well, that call proved profitable. But let's not get ahead of ourselves. I am not going to say buy more at the current price. With that in mind, let's examine SMCI's future. The projections are showing impressive revenue growth, and that's fantastic, no doubt. However, and I want you to notice that T here is a however here. We need to see those profit margins improve to truly justify a more bullish stance. I want to repeat, we need to see improvement of the profit margins. For now, it's a hold from me with a healthy dose of cautious optimism. I'm not saying the stock is bad, but I am watching carefully. Remember that key concept from a previous slide about the improvement of profit margins? Well, it plays directly into the whole AI infrastructure boom. Morgan Stanley is reiterating its bullish outlook on AI chip stocks, and that's not just wishful thinking. We're seeing concrete evidence of this. We're talking about major players, Amazon, Google, Microsoft. They are all, I repeat all, significantly expanding their capital expenditures in AI. And it is a fact, not speculation. This leads us to an interesting paradox, though. While many companies might benefit, SMCI is particularly well positioned. They are a key player in providing the infrastructure that powers this whole AI revolution. Think of them as selling the picks and shovels during a gold rush. But, and you know I always present both sides, the analyst consensus on SMCI is currently a hold. And the average target price? It's pretty much hovering around where the stock is trading right now. So the market as a whole isn't quite as enthusiastic as some of the individual analysts. It's telling us, proceed with caution. There are some uncertainties. While the long-term potential is undeniable, the short-term might be a bumpy ride. We need to see that profit margin to judge. I will repeat once again, we want to see the profit margin, and that's where NVIDIA, the titan of the AI chip world, comes into the picture. Let's break down their latest earnings report, and I'll tell you. Here is a lot to unpack here. First, the top-line number, Q4, revenue clocked in at $39.33 billion. That's a staggering 78% increase year-over-year. And it beat analyst expectations of $38.25 billion. So, on the surface, fantastic, right? But let's dig deeper. The gross margin, a key indicator of profitability, was 73%. Sounds good, except it's down from 76% in the same quarter last year. And it's at the lower end of what NVIDIA themselves had guided. I am not saying it is bad, but it is something to watch. Now, the engine of NVIDIA's growth, their data center segment, that's where the real action is. Revenue there was a massive $35.6 billion, up an incredible 93% year-over-year. This is where their AI chips are flying off the shelves, so to speak, but we can see that it's slower than before. Meanwhile, their gaming segment, once their bread and butter, is actually down 11% year-over-year. It shows how much the company has shifted towards AI. So, the future. What does NVIDIA see in their crystal ball? For Q1, they're forecasting revenue of $43 billion, which is above what analysts were expecting. Sounds great, but hold on a second. That projected gross margin, it's 70.6%. That's below expectations. And that, my friends, is a bit of a yellow flag. A point we'll explore further in just a moment, as it raises some crucial questions about the dynamics of this market. We are looking at a somewhat mixed signal. Good revenue, but margin to be considered. We just saw a somewhat mixed signal, so let's delve a little bit more about NVIDIA. Revenue growth, while still undeniably strong, is decelerating. It is normal considering the size of the company. But it is important to keep in mind, we're not seeing the explosive leaps we saw in previous quarters, and that's something to keep in mind. But here's the real point of concern for me, and it's one that's been developing over the last 2 quarters. Gross margin is declining, 2 quarters in a row, and that's not a trend we like to see, especially in a company that's supposed to be benefiting from economies of scale. It is very concerning. Now, on the positive side, here is Blackwell. The ramp-up of their new Blackwell technology is nothing short of phenomenal. $11 billion in revenue, and they're calling it the fastest ramp-up in the company's history. That is impressive, and it shows the sheer demand for their cutting-edge AI tech. This is, without any doubt, a positive point, but that's not the whole story. Let's turn our attention to another crucial aspect. Who's buying all this stuff? It turns out a huge chunk of NVIDIA's revenue, a full 50%, is still coming from a relatively small group of large cloud service providers. Think of your Amazons, your Microsofts, your Googles. Now, this isn't necessarily bad, but it does create a certain level of vulnerability. It means NVIDIA is heavily reliant on the continued spending of these giants. It's not a bad thing, but we want to see more diverse customer base, not just limited to the big players. So, with all of this in mind, there are some burning questions that I expect to be addressed in the earnings call, and I'll be listening very closely. First, what's the root cause of that margin decline? Is it simply a temporary issue with ramping up manufacturing of the new Blackwell chips? Or, and this is the worrying possibility, are we seeing pricing pressure from those big customers? Are they starting to flex their muscles and demand better deals? And second, how about DeepSeek? What about the impact, if any, of DeepSeek? Remember, a smaller, potentially disruptive AI model? Is that affecting demand for NVIDIA's chips at all? These are the answers we need to get a clearer picture of NVIDIA's trajectory. Let's broaden our scope beyond just NVIDIA and look at some other key players in the tech and automotive sectors, because the trends we've been discussing have ripple effects. First up, Charnim, or Salesforce. The story here isn't as rosy. We've seen their revenue growth slow down, and they've actually lowered their forward guidance. Because of this, we have to adjust our valuation downwards. It is basic finance. This brings us to a critical question about another company, Snowflake or Snow. Now, Snow is a different beast altogether in my view, and the data backs this up. It's still significantly overvalued even after recent dips. If you are looking to trade Snow, I'd strongly recommend relying on technical analysis, charting patterns, support, and resistance levels rather than fundamental valuation, because the fundamentals just aren't there to justify the current price. I want to emphasize, it is an overvalued stock. So what does this all mean for AMD? We've talked about the AI boom, but Advanced Micro Devices, or AMD, another chip maker, is also feeling some headwinds. Like SRM, they've revised their forward guidance downwards. Now, I am not saying to avoid those stocks, but I am saying to adjust expectations. I am personally expecting a reversion to the mean, meaning their stock price may not keep increasing in short term. And finally, let's talk about Tesla, TSLA, a stock that always generates strong opinions. Right now, the stock is approaching some strong technical support levels. What does that mean? Well, it suggests there might be a buying opportunity for short-term traders if you are comfortable with the inherent volatility. But, and this is crucial, any investment in Tesla at this point should be based on a careful analysis of the technicals, the risk-reward ratio, and your own tolerance for potential swings. I will repeat, any investment in Tesla at this moment should consider the risk. It's not a stock for the faint of heart, but it does offer potential, provided you approach it with a clear strategy and a realistic understanding of the risks involved. We have covered a lot related to individual stocks and sectors, and all point to the broader market, and honestly, the overall market behavior right now, I describe it as erratic. Many analysts are linking this directly to what they're calling headline risk, a clear echo of the Trump era. Think about it, the market reacts in real time. We are not talking about abstract concept here now. You might be wondering, is there any pattern? It turns out there is a discernible, albeit unusual, pattern emerging. Fridays and Mondays statistically have become the worst days for trading. And what about the middle of the week? Well, that's become almost entirely dependent on, you guessed it, Trump's latest tweets. It's a market driven by news cycles and policy pronouncements, more so than underlying fundamentals, at least in the short term. So what does this all mean for us? This leads us to a critical question that analysts are grappling with. Is this just a temporary blip, a short-term anomaly, or are we witnessing the birth of a new normal in market behavior? It's a crucial question, and one without a definitive answer yet, but I can consider a situation where the current conditions of uncertainty persists. And that's where company topic comes in. My personal view, and it's one shared by many, is that as long as these yielding tensions and this policy uncertainty persist, this erratic trading pattern is likely to continue. It's the world we're living in, a world where headlines can move markets just as much as, if not more, than traditional economic indicators. It's a challenge, but it also creates opportunities for those who can navigate the volatility. We have covered pretty much everything, from individual stocks to the broader market. Now it is time for you. If you found this video helpful, please give it a like. It helps the channel more than you know, and it lets me know you are getting value from this content. And if you haven't already, hit that subscribe button. We are constantly putting out new videos with finance and investment insights, and you do not want to miss it. And remember, this is a conversation. I genuinely want to hear from you. Share your thoughts, your questions, your market predictions, all of that in the comments section below. Let's get a discussion going. What do you think is coming next for the market? Are you bullish, bearish, somewhere in between? Let me know. And last but not least, be sure to click the link in the top comment. I have some additional resources that might be helpful.